How's it going, guys? It's your boy T-Wolf Trader here. I got another video for you. Today I'm going to be talking about this intrinsic value calculator. Now, this intrinsic value calculator is a value investing method for determining the price of a stock today based on future growth estimates. And I made it dummy proof by color coding it, adding some cool line plots, and making it real easy for you to use by hyperlinking all the websites you need to get all this information. And so hopefully in no time you'll be trading like Warren Buffett. And what I mean by that is long-term value investing. Not very exciting, but slow and steady wins the race. So in these first couple cells, you want to put in information about the company as it currently stands. So you're going to start by entering the ticker. The ticker symbol is important because all the hyperlinks below it are tied to it. So if you click on this last price button, you can click that. It'll take you right to Yahoo Finance, show you the last price for Apple, 115.36, and you'd enter it into that third row right there. Below that, we're going to need that earnings per share trailing 12 months. And if you scroll down on that same page, it's right there, a value of 330. 330 goes in that fourth row. Now, in the fifth row, we're going to want to put the growth rate, the analyst consensus growth rate. Now, these are a bunch of bigwigs up in, the New York Stock Exchange, playing around, with their insider tradings, and they know things. But anyways, they've come to a consensus on what the growth rate should be for this stock. And if you go to the analysis tab and you scroll all the way down, you'll go to the growth estimates. For the next 5 years, they're estimating about 12.5% growth for the next 5 years. So you plug that number in that fifth row. Below that, you want to put in the price to earnings ratio. Now, the price to earnings ratio is interesting because there's two different ways you can put this in here. You can use 2 times the growth rate, so it'd be 24 in this case, 25 maybe, or you can pull historic price to earnings ratios and take an average. So if you want to do the second method, you can just click on PE ratio. It'll take you right to MSN Money, not Yahoo Finances, because they're weak. They don't got the PE ratios apparently, I guess. I don't know. But anyways, you type in the ticker symbol, take you to that ticker's webpage, go to the analysis tab, go to price ratios, look at the historic price ratios, 5-year high, 5-year low, take an average, about 15. So we use about 15 here. You really want to take whatever number is lower of the two methods. And so we're going to use 15 there. Then you're going to pull the number of shares outstanding. You can click there, take you right to Yahoo Finance, and you can pull out the number of shares outstanding from the statistics page. Just scroll down, 17 billion. That's a lot of shares. And you're going to input it in the spreadsheet in millions. Below that, you have the last 5 years net income. Again, you can click on net income. It's tied to the ticker symbol, and it'll take you right to the financials history. You're going to scroll down to net income after taxes. So you're looking at these numbers here. I made it real easy for you. You can literally just copy, Control-C those 5 values, paste it in here. Now you have to be careful because they're going to come in billions and it's going to screw up this spreadsheet. So you're going to want to go through there and add a decimal point to each one of those numbers to put them in the millions. And so you do that, you clean up those numbers, make sure they're in the correct units, and then you can move forward. Below that, you need to input the discount rate or the inflation rate, about 5% for the US economy. You can play with that number up and down 1%. It won't change the numbers too much, but it'll have some effect. The minimum rate of return is going to go here. So if you're investing in one stock, you definitely want your minimum rate of return to be higher than that of the S&P 500 because you're taking a bigger risk by putting all your eggs in this one basket. So you're going to want to use a minimum rate of return of 15%, which is roughly double the S&P. Now the margin of safety is going to be used in the fair value calculation to determine if to determine what price you would want to enter the stock at, such that you have a 50% margin compared to its future value. So 50% is what I recommend, but you can go down as low as 30% if you really believe in the company, if you have a higher risk tolerance, that kind of jazz. Anyways, once you input these couple rows, you could be done. Everything else just calculates downstream. So there's two methods by which I project what the value of the stock should be. One is the discounted growth method. So it uses the net income values here to estimate a growth rate for the future value of the stock. It projects earnings into the future based on the latest earnings. So using the latest earnings and that growth rate, we can project that in 10 years, Apple will be having a net income of over 100 billion. That seems excessive, but these models aren't perfect. They have these exponential extrapolation, which isn't very accurate, but it'll get you some idea. And then you have to use the discounted rate to evaluate what the present value of those future earnings are. So basically those future value earnings minus the inflation. And the present value is there, and you can sum all those up to get the present value of the future earnings of the stock, and divide it by the number of outstanding shares to get an intrinsic share price here. So again, that total present value divided by outstanding shares in millions gets you a valuation of $35 basically for Apple. And it's trading at 3.3 times that. So that's excessive. That's quite a speculative growth stock, so that's why it's up that much. Now the second method uses the fair value forecast method to project the 10-year share price. So basically you take the EPS and the analyst consensus growth rate and you project it out 10 years to get an EPS of $9.50 in the year 2029, and then it goes over to the price to earnings ratio, or so use the price to earnings ratio and the EPS to determine that the stock price should be $142 in the year 2029. And then you reverse track using the minimum rate of return what that translates to a current value of the stock. So currently, using a minimum rate of return of 15%, that stock price should be $40. So if you use that there, the fair value today of Apple is $40, giving us a margin of safety of negative 65% compared to its current price of $115. And if we really wanted to buy this stock with our 50% margin, we'd actually want it to be $20. So it's trading upwards of 5.7 times what we want this stock at. So based on these two metrics, this stock is overvalued, which makes sense. We had a bull run in August, and prices are finally starting to correct here in September. But these tech growth stocks are highly speculative and highly overvalued. If you haven't been living under a rock, you know this. So I would not be putting my long-term investment portfolio in this at this price. So in this spreadsheet, I've done the same analysis for Square and Facebook. So you can just click on these tabs at the bottom to see what those analyses look like. Square has slightly more reasonable fair value forecast, trading at 1.4 times the price to be desired. The discounted income growth method doesn't work so well for this stock because the income growth rate is based on the net income, and it's had some negative net incomes for the years of 2018 to 2016. So I wouldn't trust this first method for any companies that have negative earnings. I would use the second method. Facebook, its discounted growth and its fair value estimates are actually in line with each other. So this is actually looking like a fairly decent stock. It's only, about 2 times, trading at about 2 times what we would want to buy it at based on the fair value. So there you have it. That's a spreadsheet. I've gone through it, and if you have any questions about it, feel free to drop me a comment. I'm happy to answer anything. And I'll be actually looking to make another spreadsheet, so if you have any ideas of things you'd like to see, let me know. I hope this intrinsic value calculator gets you looking at your portfolio in a different light, actually crunching these numbers and determining if you're buying stocks which are highly speculative, which I think a lot of people are doing, and we're going to see a market crash in the coming future, I think, because of that. This market is so overinflated. But anyways, that's a story for another time. I'll let you go now. Thanks for watching, and I'll see you in the next video.